Welcome to Quarterly Conversations. Good afternoon. Hope everyone is doing well. We're going to get started here with what we're going to cover today. So we have what seems to be sort of our usual suspects for the last few quarters, but these themes aren't going away. And there's reasons to be optimistic and pessimistic. And Rick and I were chatting a little bit about this just as we were starting. But one of the sort of most surprising outcomes with the continued inflation conversation, how the Fed sort of created that, as well as how they are now reacting to that. Is the fact that the U.S. bond market is down so drastically. And actually, one thing I didn't mention at the onset was that this is the longest drawdown in the U.S. bond market in history as of this month.
And I just picked it up off of AlphaCast. The AG is the worst drawdown ever. So that's never gone below new. That 9.14% negative.
So that's new. As of the letter, I already have to revise that. As of the letter, it was the largest drawdown since 1981. So now we're into the largest drawdown ever territory, as well as the longest drawdown ever in the bond market. So that is certainly something that is going to be an underlying theme. One thing to just draw a comparison, and I was talking about 1981 since that was the last time we had a large bond drawdown. But at that point, the yield on the 10-year Treasury was close to 16%. So the bond market, after it bottomed out, it snapped back within 2 months. Today, the 10-year is at about 2.7%. So we don't have as much room for the bond market to recover. So that is certainly concerning. And we'll talk a little bit about, I'm sure everyone's read the headlines, or maybe you've dug a little deeper, on the yield curve. And then, what that means for investment returns, kind of a 10-year outlook. We typically have some financial planning topics, but this quarter, with just kind of everything that's happening right now, we're actually sticking to pretty investment and economics heavy talk here today, simply because there's a lot of stuff to dissect. We'll kind of go through where the economy is as the pandemic's fading, how the Russia-Ukraine conflict is impacting some of this stuff, and obviously, policy shifts. So I don't know if you want to add anything there, Rick, but
I got there's all I can add is there's a lot of variables right now.
Yeah.
More variables than in past history that are going on that's going to affect this economy. And it'll be interesting because some of those variables, the yield curve, and we'll talk about that. So I'll stop there till we get up.
Yeah. So, one of those variables is inflation.
This is one of the best. I like this chart a lot, the way this depicts the difference. We talked a lot about transitory and sticky inflation in the past and on last quarterly conversations, but this chart kind of identifies it pretty well.
Yeah. So, and this was actually embedded in the letter as well. So we have essentially these top three, energy, new and used vehicles, and food are considered transitory inflation, and then these three, shelter, restaurants, hotels, transportation, and other, are considered sticky inflation. Yeah, one thing is that's actually kind of interesting is I've been reading about transitory inflation for it seems like for the last year since we started looking at this. And one thing that's kind of interesting about that is there really is no definition as to what constitutes transitory from a time perspective, meaning it's transitory, but that doesn't necessarily mean, obviously, as you can see from this chart, that next month it's going to go away. So one thing to just keep an eye on here with inflation is the argument of, oh, well, inflation is transitory. That's all well and good, but if we've had steadily increasing inflation at this point for over a year, and this is as of February, the March numbers are still increasing. It's actually 8.5% in March. So we don't have of course, this chart breaks it down. I don't have the breakdown, but the headline number recently came out, and it's continuing to accelerate. And I think that if looking at the sticky inflation versus the transitory inflation, sticky inflation is actually right around 4%. And that is the Fed's targeted inflation rate is 2%. So even if we say, well, the transitory stuff is sort of, that's volatile, it ebbs and flows, it's likely to revert to the mean. The fact that sticky inflation is double what the Fed's target is certainly a concern.
Yeah, and the energy not likely to go away anytime soon either, because of the Ukraine war and the games that Russia's playing with their oil. So it's not something that's going to disappear tomorrow. So the question is, what's the definition of temporary? Even
Right.
when you get into new and used car vehicles, new car vehicles, from what I understand, they're sitting on the car lots of the manufacturer waiting for microchips in various different places. Not just, it's not just one microchip that they're missing. They're missing the new car start microchips. They're missing microchips to make the car start and stop at a stoplight, things like that. So to get the cars out, they're actually shipping them without those benefits to them.
Yep.
So believe it or not, but that's not likely to end anytime soon either, especially when China's working on or still going into their lockdowns. China, Taiwan, Hong Kong, all holding up the chip manufacturing in that respect. And it takes time to start that back up again. It's not easy. The other thing I just want to mention here too, Dan, is we talked a little bit about existing home sales and new home sales in past quarterly conversations too, and we talked about some things to watch out for, and new home starts increasing, new housing starts.
Housing starts, yeah.
And we just got some information recently that new housing starts are increasing this past quarter. So they're starting to kick up a little bit, but at the same time, existing home sales are starting to slow a little bit. And I think a lot of that has to do with interest rates being over 5%.
Yeah, so that I actually did want to. The interest rate piece is, as from an inflation perspective, is important because, if you've looked at just a conventional, conforming loan, 20% down payment, 30-year, those rates are now over 5%. I think, not 1 year ago, I mean, we were at historic lows on those rates. That was close to 2%, or in the 2% range, a year ago. So, and that is really, I mean, that's directly related to inflation. The Fed is projecting 7 rate hikes this year. The futures market is predicting 8. You know, and I certainly do I think what's concerning is that you've had these hikes and you've had mortgage rates go up, but inflation still continues to go like this, right? Because the theory is that, look, you know, if you have an overheating economy with inflation running rampant, that you increase interest rates, we have a lot of room to go, right? Because we were starting at like 0. So the theory is you just increase rates, and that'll help to sort of choke off some of the frothiness, you know, of the economy, and choke off that inflation. But obviously, so far we have not seen that. You know, March with this accelerating to 8.5%. Producer price index too, 11.2% year over year in March, the highest since 2010, so the highest in the last 12 years. And consumer expectations of inflation are actually at 6.6% 1 year from now. So consumers are expecting that inflation will mediate, which is good, right? Because inflation does have a lot to do with expectations. But you know, 6.6% is still high. And what seems to be happening is just 1 month prior, so the February numbers for consumer expectations of inflation, it was 6%. So consumer expectations of inflation also continue notching up, even though they expect it will subside, you know, over the next year. Each month, as it continues to go up, consumers are still adjusting their expectations for a year from now up. Right. So there is still, you know, depending on how permanent that transitory piece ends up being, especially as you mentioned with the war in Ukraine, you know, if we're going to be able to get this energy inflation under control, and get some of the supply chain issues, you know, worked out, right? You know, right now, as we sit here today, the Fed's policy is not working because they're increasing rates and inflation is still going.
Yeah, so they got a couple of tools that they're working with right now. One is increasing interest rates, and the other one is just reducing the balance sheet right now. I believe we have 11 trillion on the balance sheet.
Yeah, some absurd number like that.
Yeah, so as they start to reduce the size of the balance sheet, and there was a chart that we did not put in here that talked about that they could potentially reduce the size of that balance sheet over a period of 4 years, I believe.
Right.
Fairly aggressive pace. I mean, we built it up over a period of 2. Actually, almost a period of 12 years when we started QE1 way back in 2010, I guess it was.
Right.
And then we started reducing it in 2015, and then it started, you know, then 2020, March of 2020 came along, and it popped back up again. But the fact is they can reduce it over a period of the next 4 years, which is also another play into that, another tool in their quiver to be able to utilize with, you know, not just interest rates. Speaking of dead cat bounce, let me explain that. That's interesting that you put this to the CPI, Dan. Dead cat bounce is it's typically when you see a bunch of shorts coming in on a specific stock, and it's starting to push the stock downwards fairly aggressively. The stock begins to fall, and all of a sudden the shorts come back and cover. They start buying back into the market and covering their short position, which pushes the stock back up, and inevitably it could keep dropping from there. So, but it's interesting that you put this in, you applied this to the CPI. Talk a little bit about that.
Yeah. So, well, that, you know, and it's part and parcel to the Fed's balance sheet. So, you know, as we've discussed many a time, you know, what the Fed did with its quantitative easing program, which really was enacted after the Great Recession, was that they essentially started flooding the markets with liquidity. You know, in many different ways, creating capital, you know, buying bonds on the open market, and they after the Great Recession, they, did that over a series of what they called quantitative easing programs, and over time, it had the effect of building up their balance sheet. That's essentially open market operations to create liquidity in the markets. In after COVID, they did that at a similar magnitude. In fact, a greater magnitude than the Great Recession, but they did it all at once. They did it all at once right after COVID. $5 trillion, added to the balance sheet, liquidity created in the markets. And the reason that's has a very similar impact to a dead cat bounce is there was nothing that really came due. It wasn't like an actual dead cat bounce where you have short positions that need to be covered. But the Fed just flooded the markets all at once. And they flooded the markets so much so that, inflation just it did that and continues to do that. What this chart actually is showing is it's meant to sort of distinguish between those more transitory volatile components of inflation and what they're calling core CPI. So as you can see, the blue line is a little more volatile. It tends to ebb and flow, but the gray line is smoothed out, to indicate what would be considered, the more steady factors or contributors to inflation. And obviously what you can see here is they're kind of moving in lockstep since the Fed flooded the markets. And I think it's important to understand because the Fed pushed so much money in that this was just inevitable, unfortunately. And there are a lot of consequences to that, and a lot of questions that we have to ask as investors about, what that means, simply because this is just like a lot of markets in past, this is, it is unprecedented. I mean, the Fed has not done this before. So this type of a spike, I think we had compared it again back to the 70s and 80s when we had runaway inflation in the past. But, it's similar. It's somewhat like currency manipulation. When you go off the gold standard, we had inflation spikes. Not the same thing, but still currency manipulation. So, that's what this is meant to convey. And
the dead cat bounce here is like a flurry of buying back into the market of short sellers, and this is more or less of flooding the market with cash.
Right.
Yeah.
Right. Yeah. And I just want to point out, so that there's a dotted line here in the middle, right across. That's sort of your that's your mean. So to kind of revert to the mean. So I said before, the Fed is trying to reduce inflation. Like you can see the spread there. It's a pretty dramatic spread, and it's continuing to increase.
Yeah, and that's where we were talking about. I mean, this is not. I mean, you and I were talking back and forth, and when we have some of our advisory meetings, we talk about that inflation, when it comes back to settle down, it might not settle down at the Fed's 2% target rate. It might settle down just above 3%.
Well, and the Fed's admitted that.
Yeah.
They've admitted, they've said, like, even though 2% is their target, they've admitted that they're willing to live with, a low 3% over the next decade. And honestly, like, that is probably what their target should be. Because again, you look at the 50-year average here, and it's, you're like low threes.
A 3 to 3.5% inflation rate is not that bad. I mean, it's easy. It's easy to live with a 3.5% inflation rate. But when you go 10 years with high inflation, like we did back in the 70s and early 80s, that could be pretty drastic. And we don't necessarily see that coming.
No. So if we could start getting it under control, I mean, and we'll talk a little bit more, there's reasons to be optimistic. Rick said housing starts are looking good. Earnings season is upon us, and there's some well, other than the high flying tech stocks like Netflix, there's some promising numbers for earnings. Even though obviously the Russia Ukraine conflict has energy price implications, it's the impact on the U.S. is much smaller than overseas, but obviously on the more pessimistic sort of bear case side, inflation is a big concern. Interest rate increases, but and also the fact that the Fed is going to look to tighten their balance sheet, and historically there's been a 91% correlation between their balance sheet and the S&P 500. So that's not great. And the other thing is that the Fed has never lowered inflation by 4%, which is what they're pretty much looking to do now. They've stated that they're willing to live with inflation in the 3% range. They've never lowered it historically and not caused a recession by that much, by that magnitude. And the reason I bring it up is that what the central bank is doing right now has a major impact for investments. And you've probably read about different extraneous factors that could impact the markets, and one thing that always comes up is a policy mistake. And it's my opinion that the policy mistake has already happened, that horse is out of the barn. When the Fed flooded the markets with cash, they created a big problem. That's why we have the runaway inflation that we have right now. That's why we have a hot economy. But interestingly enough, we just saw today, surprisingly, that GDP actually contracted in the first quarter of 2022, which raises some other questions.
A couple questions. Actually, there was some policy mistakes that were made back in the early 70s, I believe it was, that continued to push inflation higher. It actually created more towards the later 70s. It created a lot of unknown in whether inflation was ever going to slow down, and started causing buying frenzies. And instead of slowing down the economy, the economy actually sped up, because people wanted to get in on the last purchase of a house before inflation went higher, and various different products like that. So
right.
But all due to some. And it was pre-Paul Volcker, I believe it was. So.
Well, yeah, until Volcker came in and ruled with an iron fist.
Right.
But it's interesting because it's sort of a trade-off of what set of problems not only the Fed but as investors we will be dealing with here. It's pretty clear that the inflation issue is not going away. Whether or not it can mediate or start to kind of turn the other direction is yet to be seen, and we'll talk about that a little bit in a later slide. But there's pros and cons here to both, right? So having a healthy economy with rising inflation is different than obviously what you're alluding to, Rick, a hot economy, like overheating, right? So much buying and so much growth that it's actually they're feeding off of each other, right? Like the economy is fueling inflation and vice versa. That's not necessarily a good problem to have, just simply because it's hard to control either of them if they're feeding off of each other.
Well, it was due to various policy mistakes that were made back then. And the unknown, or the lack of understanding of whether inflation was actually going to be brought under control. And,
sure.
It was you talked about it a couple minutes ago, a start-stop economy. So it was start-stop quite a bit through that time frame.
Right.
And that's what they were getting. That's what actually led to the frenzy.
Yeah, and depending on who you talk to, this, again, my opinion is the policy mistake happened, but like you're saying, Rick, like there could be multiple policy mistakes. So, hey, maybe they made a mistake with creating so much liquidity, but are they now being too slow to act in response to inflation, which may be the case? They seem to be really biding their time, and now all of a sudden inflation's over 8%. And now we're starting to hear them get more hawkish. But I think that the needle that they're trying to thread, and this is why it's so difficult for them to achieve a soft landing, is that if we have runaway inflation like this, but we start to see that the economy is contracting, that's also not a good problem to have, simply because now you're sort of, and we'll look at the business cycle later, but you're sort of creating a situation where you have characteristics of both a expansionary and contractionary part of the business cycle. So if you could imagine, what do you do when the housing market is overheating, right? You raise interest rates if the housing market's overheating, if there's excess demand, if inflation is running away, you raise rates to make it more costly to obtain capital and hopefully slow down that inflation, slow down that growth. But what if the economy is contracting? Typically, if the economy is contracting, you're doing the opposite. You're making those capital constraints a little bit easier, right? You typically would want to reduce rates so that you can start to stifle some growth. So it's going to be difficult if we start to see that, just like we saw for Q1, that the hot economy is turning into a contracting economy, but inflation is still going, because now you're kind of damned if you do, damned if you don't. It's very difficult to determine the correct policy action at that point. And remember, a lot of these too are, they're lagging indicators, right? We're looking at past data, and the Fed is making their decisions based on that past data. So if they miss the mark, the horse is already out of the barn.
And speaking about policy mistakes, there's a comment on the question and answer that talks about the high energy prices right now, and actually oil is up over 105 today, which can also create a lot of damage on the economy. And the comment goes back to, why don't we could be energy independent, and why not fix this problem, Dan? And you and I were talking about this earlier before the call today, when we were talking about how the GDP was came out below, much lower this quarter, and the fact is that we can be energy independent, but we were producing a lot of oil from 2016 on. We actually were number one producer of oil, and by 2019 we're the number one producer of oil in the world, and then we slowed that down. There's various things that go into that. I guess it's policy mistakes. Is we don't produce it, so there's a lot of red tape coming into the production of oil prices, and with a lower GDP, we were talking earlier. You said it could cause more of a stagflation,
right?
And if we do, and we've seen already that they're starting to turn off the spigots a little bit, I think. But not like they did back in 2016.
Turn on the spigots, yeah.
Turn on or turn up the spigot.
Turn up, yeah.
Turn them up a bit. So, we're starting to produce a little bit more oil, but they can crank those spigots on pretty aggressively, if they so choose. But that's a political thing. I guess that's more of eliminating red tape, and they know it can be done. It's just,
it
why
is,
don't they do it?
And I think they're going to, simply be, but I think that also is a little overblown. There's two things. Number one, and I'm not sure if everyone can see the Q&A or not, but I'm just gonna read the question off just so we're all on the same page. And by the way, if anybody has anything as we're going through this, feel free to put it in and we'll address it and try to keep moving. But I'm just gonna read the question here. Inflation is mostly secondary to energy prices, which is probably secondary to the crushing of America's energy independence. Why not fix this problem and drop energy prices? So what I would, my response to that would be a couple of things. One, I would say that as we talked about in the first, I think it was the first slide, I guess, the components of inflation. Energy prices are a major component of it. I don't know if I would say it's secondary necessarily to energy prices, simply because, as I had pointed out, the sticky part of inflation, which has nothing to do with, new and used autos or energy or anything like that, is still rapidly increasing. But I would agree that, energy prices have a large part of what's a large component of the headline inflation numbers that we are seeing recently. And it's typical. And as far as the crushing of America's energy independence, there's a couple of things. I mean, America is a net importer of crude oil. So and we were going back, I guess it was probably about 2 years. That was not as much. We were still a net importer, but not to the same magnitude. But as far as total, we are actually net zero, because we are a net exporter of refined oil products.
Refined oil and natural gas.
Right. So there's a lot of midstream companies in the US who are, yes, they're importing crude, but they're actually exporting, net exporters of natural gas and refined petroleum products. So technically, like, if we, depending on obviously how you want to slice it, but if you just look at in total, the US is net zero when it comes to net imports of oil. It just depends if you want to look at oil in total or just crude, which from a production standpoint, of course, if you're a net importer of crude, then you are, you're not producing as much as you're consuming. However, we do have midstream companies that are sort of leveling the playing field by exporting refined products and natural gases.
That could also be a tool being used, politically, if they wanted to control it. So they could control that inflation and bring us in, working together with the Fed to bring us in for a soft landing. But I don't even think that worked.
Yeah, and I would say the other thing too is, I don't know if it's quite as easy to just fix the problem, because again, most of this happened when Russia invaded Ukraine. And for the US, it may not be quite as big of a direct impact, but everything globally is so interconnected now that when you have what the heck's the Russian oil company, Gazprom, when they're effectively only accepting payment in rubles, and they're not sending gas across the border. I mean, it's just that's going to have a domino effect overseas. It's just I don't think that there's really any way from an economic perspective to just say that, we should just drop prices. That just seems, we will certainly do that over time, but I think that that's how long does actual transitory mean? It's transitory, right? Like it's not like we can just do it within 30 days, but I certainly think that I certainly think we're going in that direction.
Yeah. We should pop to the next slide too.
Yeah.
So we don't lose time.
So, Rick, you want to hit this one?
Sure. The inverted yield curve. The interesting part about this is when they're talking about an inverted yield curve, they're talking about the 2 and the 10. The 2-year and the 10-year actually flip. A normal yield curve will go more or less straight up, or straight diagonally bottom left, top right. But you can see Dan's putting it on the 2-year and the 10-year, and you can see that that yield curve is actually, the 2-year is higher than the 10-year. That's what they call an
Very
inverted yield curve.
slightly.
And the last time
I
this
did
happened,
that wrong, but yeah.
what's that?
I said that was close enough, but you get the idea.
Yeah, that it's, yeah, the 2-year is higher than the 10-year.
Yeah.
And this happened actually 28 times since 1900, and 22 out of the 28 times of recession follow. So not every time does a recession follow, but it is a leading indicator that a recession will follow. Now,
Yes.
I read an article in Kiplinger's that talked about the inverted yield curve, and basically they said that it's caused, as you were talking a little bit earlier about large inflows of the Fed's relentless buying of bonds. Relentless buying of bonds is a consequence to their. My phone keeps ringing for some reason. Sorry about that. So the Fed's relentless buying of bonds and the consequence and the consequent growth of their balance sheet, rather than because of the looming the growth shock. Okay, so it's ultimately the relentless building of that balance sheet that caused it, which, as you stated earlier. But they also go on to indicate that although we expect the economic growth to slow this year, we do not anticipate it will turn negative. This is according to BCA research in the Kiplinger's article. It says our expectation is that several of the current headwinds to growth, price pressures, the war in Ukraine, and the pandemic situation, as we spoke, will improve in the second half of this year. So, it's not that we're going to have this negative market the entire year. There's a lot of pieces to the puzzles, a lot of variables to this puzzle that basically say that just because we anticipate an economic recession doesn't mean that that this yield curve is going to cause a negative markets in the current situation. So although we have negative markets right now, it doesn't mean that we're going to stay there.
Right. Yeah, and I would say that this is indicating essentially when you have this inversion, it's an indicator of future weakness, right? Economic weakness. And I this has been tortured from government intervention. There is no reason that you should see that steep increase from 3 month to 2 year, and then it's pretty much level from 2 years to 30 years. And the fact that it inverted means that weakness is on the horizon. I mean, one argument is that this is now unreliable or obsolete because it's now just essentially at the mercy of the Federal Reserve. My argument is that just means that the Federal Reserve is what will cause the economic weakness. So,
right, and it's because they're flooding the market with money.
Yes, exactly. And here's, I mean, really the bottom line is this, and you probably have read a little bit about it, but I think this is a good way to look at it. So the last 6 recessions, we're all preceded by an inverted yield curve. And what this chart shows you is the amount of lead time. So, from the time the yield curve inverted, from the time that the 2-year treasury had a higher yield than the 10-year treasury, the date of that inversion right here, and then when the recession started. Okay, so essentially the peak of the market. On average, over the last 6 recessions, it was 19 months from the time the yield curve inverted, which was this month, to the time the recession started. Anywhere from 7 to 35 months. So, the interesting
Take us
thing
into
with that,
2024.
yeah, well, even more, like that means we would have a recession anywhere between November of this year and March 2025.
Right.
So, I mean, I would not call that precise in the least bit. It basically, which is why it's funny, because this seems to be the one indicator that almost always it calls it. It's the one leading indicator that everybody always points to. But the point is it really just says more about there's economic weakness out there, and there's really no precision to, well, hey, every time the yield curve inverts, you have a recession within a year. It's like, anywhere from 7 to 35 months. That's, if I said to you, without all sort of the hoopla around this market omen, if I just said, hey, we're probably going to have a recession sometime in the next 1 to 3 years, I think most people today would probably say, yeah, that sounds about right. But that just seems to be where consumer confidence is. And Rick and I were talking about that a little earlier, but consumer confidence is way down. So it's not exactly surprising, that I would say, hey, we will likely have a recession sometime in the next 3 years. But here's the thing. Because of that lack of precision, this is the exact reason that you stay invested. Because this is the less talked about side to that. So the same last six recessions, last 6 bear markets, where the yield curve inverted. What this is showing is in that 19, on average 19 months, lead time before the recession starts, on average, there's a 27% gain in the S&P 500 from the time the yield curve inverts to the time the market peaks. In other words, from the time the yield curve inverts to the time the bear market starts, you typically get an average 27% return on the S&P 500. So, this obviously is not an indicator of anything timing related. It's more of a long-term indicator that the economy and the market is entering a phase of contraction, of weakness. But it certainly is by no means a signal to say, we got to sell everything and get out, because if you did, on average, you're losing a pretty large gain. And in many cases, that gain, as you can see over here on the left-hand side, where's my tool? Right, half of the time here, that gain is enough to offset the decline. Right. So in other words, if you were to sell out the day the yield curve inverted, and then hopefully, just wait out the recession, right? You'd be in the same spot if you just held on, right? Because you're getting the gain and you're getting the decline. Sure, it's a little bit more whiplash to actually hang on, but you'd have to time that perfectly. And it would be very difficult to do. So it's
difficult,
almost impossible.
But I hear from a lot of people it's easy to time that.
Yeah, well,
the question is when are you getting out, and how far is it going down, and when are you getting back in?
Mm-hmm. Yeah,
nobody can answer those questions.
Yeah.
So staying fully invested, making some tweaks. There's opportunity. Well, actually, we got a chart towards the end, I think, right, Dan? We could talk about that a little bit later too. But,
yeah.
But yeah, so the return on that market on the S&P 500, we can't, based on that article that I was just talking about, they were anticipating a similar things. The fact that we do have gains typically that follow an inverted yield curve.
Right, right. I do have a question here. I'll go through it quick because I don't know the answer to it. They asked what is the relative strength indicator today? Just for everyone's, and I'll have to look it up, but just for everyone's knowledge, and I think I'm getting the numbers right here. I think it's 30 and 70, but the relative strength indicator is a metric that I think it goes from 0 to 100, and if the relative strength indicator is over, I think it's 70 or 75, then it's overbought. And if it's below like 25 or 30, it's oversold. I don't know where it is today. I'll have to look that up. But at any rate, we'll send that out after the session here.
Unless I can find it before.
Okay, yeah, that'd be great. So what does this mean for returns for investments? Over the long term, because basically, what we're looking at here is with the yield curve, not a precise indicator. We're talking about economic weakness. We're talking about a broader cycle. So what this is looking at now, this particular return projection. This is from the Vanguard Capital Markets Group. This is their 10-year nominal return projection. So this has nothing to do with inflation. We're not adjusting for inflation or anything like that. This is their 10-year nominal return projections, annual, average annual. It gives a range for each category. And I think, the takeaway here is that with economic weakness on the horizon, these are, drastically scaled back. Maybe not, as big of a surprise, for a bond investor. On the bond side, we're seeing, low 1 to, somewhere in the middling 3% ranges for returns, depending on what asset class you're talking about. To me, the major takeaway here is actually right here. This is basically saying that, domestic U.S. growth stocks over the next decade are going to be essentially flat. So that's saying anywhere from negative 1.2 to 0.8%, average annual return. So that, there's a couple of takeaways from that. Number one, that was the asset class that has been performing well during times of high liquidity in the markets, and value has, a lot of people have been calling for value to make a comeback for a long time, but it's likely that value will make a comeback in a slower economic environment with less capital in the markets. You could see U.S. value is sort of over the next decade looking to be again, these are the dividend stocks, lower price earnings ratios, higher cash flows. They're likely to hold up better, than those growth stocks. And again, they've been calling for this for a while. We're still sort of, we're a couple years out from this simply because of mostly the Russia-Ukraine, but they're calling for international to start making a comeback. The U.S., domestic markets have, outperformed pretty substantially over the last decade. We're still a little cautious there simply because there's a much higher risk of recession in global markets than there is domestically with the Russia-Ukraine war. But those would be my two big takeaway. Oh, and third big takeaway would be just from a growth perspective.
Emerging markets.
Yeah, emerging markets, but from a U.S. growth perspective, the flat returns, it's to me, what that says is there's going to be a lot of disparity. There's going to be winners and losers.
Yeah, that's a fact.
I don't think it means that you're not going to get returns in growth. I think what it means is that you're high flying, leverage to get growth, borrowing, your speculative tech names, they've seen their day.
Yeah, the last time this happened was in March of 2000, when the tech bubble got crushed. The NASDAQ actually dropped down in March. I think it was late March of 2000, never to return until 2015. So we had peaked up above 5,000 and then dropped down below 5,000, and it took 15 years for it to come back. Again, didn't mean that we weren't getting returns on various growth stocks, but good quality growth stocks. Part of the reason why we're focused on good quality growth stocks with higher cash value, higher cash flows.
Cash flows, yeah, stronger balance sheets. Yeah.
Stronger balance sheet. Yeah. So those companies can continue to gain growth, but yeah, but when you look at the NASDAQ and you look at the Russell, I guess it was the Russell 2000 growth, it dropped off and never to return for 15 years.
Right. And so, and I talked about just some opportunities.
Opportunity or pain.
Yeah. And so you can go, I'll mark this up. Why don't you explain this one, Greg?
Yeah. So this is interesting. So this basically shows that you can have intraday lows. These the red down the bottom are your intraday lows.
Intra-year, yeah.
Yeah. So yeah, which happened
at any given time, I guess, right?
At any given time, we could have a low in the year, and is it pain or is it opportunity? And I always look at this as opportunity. And when this chart came about, I think this is a great chart because it shows almost every single year we've had a low in that year. And in some of the years that we've had decent returns, we've had, pretty aggressive lows. You can look at.
Let me go back here. I'll show you one right. Negative 2010, I think this is negative 16.
Yep.
Up 13% on the year. Right.
Yeah, go back to, I think it's 2022 is year to date. 2020
correct.
and then 2021, we had a negative 34, ended up positive 16.
Yeah, that was the COVID year. Yep.
That was the COVID year. Yep. So, and this is 32 positive of 42 years. Which, out of 42 years, you get, what's that? It's like 70%.
75, yeah.
75%. And your average drop is 14%.
Right.
So, just because we're at I think we're down in bear time right now. On the NASDAQ, we're in the bear market.
Oh yeah, big time. Yeah.
And we are, well, actually not after today. Today we're up above negative 20%. But even the Dow and the S&P are down. We're down about a little over 10% for the year so far. And this, just because we're down 10% does not necessarily mean that's where we're going to end the year. And some of these charts that we showed you earlier are indications of that's very possible we could end this year on a positive note. So taking advantage of opportunities like this, it's you're not selling to lose, you're selling to adjust, and taking advantage of opportunities, putting some cash on top of this, will give us good opportunities to get some decent returns over the next couple of months, heading into the end of the year at least.
Yep.
So this is I'm a big fan of the business cycle. So this is indicating, I picked this up off of PNC Bank, and they tend to follow the business cycle. But when you see in here, we're right now in that slowing expansion time frame. I don't think the star is exactly right where we are. I think probably we're a little bit higher. But if you walk through the unemployment falling, wages rising, financial conditions less accommodative, credit getting tighter. We talked a little bit earlier about confidence peaks. Well, right now, confidence is not peaking. Confidence is low.
Confidence already peaked.
It already peaked. So it's we're starting to check these boxes off.
Yeah.
And then profit growth slows, and you're starting to see in the numbers coming out. I believe Microsoft came out positive. I think it was Amazon or it was Alphabet that came out a little bit on the negative side of earnings growth this recent last 2 days. But some indicators just to leave you guys with some things to watch. When the market starts to contract a little bit, you're going to start to see some of these. You're going to start seeing unemployment rising a little bit. You're going to start seeing, you potentially could start seeing interest rates declining. When will that happen? Probably when we get into that recessionary environment. You'll see interest rates declining a little bit. And you're already seeing tight credit heading. We're getting tighter. Let's put it that way.
Tighter, yeah.
And then and so your confidence has declined. So that's why we're talking about that. We might not be exactly where that star is. We might be a little bit further over to the right.
I think we're here.
Yeah,
or somewhere in that location.
I don't disagree with that.
We were talking earlier that like the big thing to look at is we're seeing a lot of the slowing expansion things right now in the markets. We just saw the first quarter of this year having an economic contraction. So what we want to pay attention to, if you look at this contractionary piece, right, these first three, okay, right there, those first three are really important. Really important. The reason is if we start to have an economy that is contracting, but these are going the other way. In other words, if inflation keeps running rampant and unemployment stays low, right? So unemployment isn't rising, or maybe unemployment is rising. These are the main variables. What does that mean for interest rates? And again, this goes back to what I was saying earlier. The reason it's important is interest rates as a tool then become somewhat ineffective because you kind of start playing a game of whack-a-mole, right? If you increase rates, that's going to help you with your inflation problem. But typically in a contraction, interest rates decline, right? So that you can start to nudge the economy into the recovery mode. Right? So if you're increasing rates, that's not exactly helping your economic growth problem. But if you decrease rates, that's not exactly helping your inflation problem. So that's why, I would, we're going to just continue paying close attention to, inflation, GDP growth, and, what that means for interest rates. But because that is going to dictate a lot about where the economy is headed and when the next recession happens. But that's for these reasons. That's why we are, you can see a lot of these, credit tight, profits fall, activity declines, confidence declines. I mean, going back to that return expectations, the sectors that are going to be hit hardest by this are the most speculative. So that's why we've been much more focused on conservative, dividend paying, large cap domestic stocks, just because we think they're going to hold up a lot better in the environment that we're heading towards.
Right. So wages, though, wages are rising, is going to be interesting because of, we have a tight, it's not tight it's not tight employment, but we're still short of people coming out to work. So there's a labor shortage, and which could continue to push for the rise in wages on an ongoing basis. So that could push it. Wages can continue to rise right into the contraction. When they start to fall, I don't know what that looks like, but that's where Dan and you and I were talking a little bit earlier about stagflation too.
Right.
So that we could be sitting in a time frame of stagflation for a little while.
Yeah, and that's exactly what I'm that's where I'm defining it's hopefully we're not, because that's where interest rate policy becomes ineffective.
Yep.
Because you pretty much you know, you go one way and it doesn't help one of the problems. You go the other way, it doesn't help the other problem. So it, you know, hopefully that's not the environment that we're heading into. But you know, those are the pieces that we're going to be looking at. You should be looking at, and these are all the reasons that, like I said, we're focusing more on value oriented domestic stocks rather than, you know, rather than growth stocks. And I think that's all we have. I know we're up against the time here, so
You're over
the time. So I'll leave it. I'm going to stop the recording. We'll hang for a second if anybody has any questions. But thanks for coming out.